Today, as I mentioned a few minutes ago, we'll be discussing Chapter 10. Chapter 10 is accounting for long-term liabilities. So we'll talk about what long-term liabilities are. I'll go ahead and share my screen. And I'll go to the Chapter 10 folder on Blackboard. As you can see, here are the two files that I was referring to earlier, the recordings for the lecture, and then some of the problems you guys will need to understand to be able to do your homework. So before we can work any problems, we need to understand what are those long-term liabilities we'll be concerned with here in class. So long-term liabilities, by definition, those are obligations that the company has to satisfy. They have to pay back their creditors. But the maturity date of those obligations is greater than a year. Remember, current liabilities, what we talked about last time, those are obligations the company has to satisfy within a year, long-term greater than a year. So the biggest issue in Chapter 10 is really accounting for bonds. And that's why earlier I said it's this chapter is not so intuitive, because chances are you have never had to work with bonds. On the other hand, chances are you have voted for a bond or against a bond issuance. When we talk about bonds, the first thing that comes to mind is the bonds that are issued by school districts, for example. So school districts issue bonds so they can tackle expensive projects like building a new school or upgrading several campuses. Municipalities also issue bonds. So bonds are a form of financing. The other form of financing you're familiar with is what we call stock financing. The company can either issue bonds and create an obligation, or they can issue stock and give the ownership away to stockholders. So when we discuss bonds, there are a few things that you guys need to be familiar with. And that's the reason why I want you to just go over the theory behind bonds today. And then between today and Wednesday, I want you to look at the book, go over the PowerPoints, and make sure you understand the terminology, because we won't be able to work problems unless you understand what's what. So we will be looking at bonds not from the perspective of the school district or the perspective of the municipality. We'll be looking at bonds from the perspective of the corporation. So the corporation usually issues bonds if they have to finance a larger, expensive project. So when the corporation issues bonds, on the date that the bonds is issued, we need to look at that bond issuance and apply the appropriate accounting treatment. So what happens when the company issues bonds is that they get financing, so cash will be debited and bonds payable will be credited. From an accounting perspective, we also are very concerned with the transactions that happen during the life of the bond. During the life of the bond, the company will be making interest payments to the investors, and those interest payments are usually made semi-annually. So every 6 months, the company will make a cash payment to the bondholders. The way interest is calculated, we're already familiar with. The interest itself will be the value, we call that the bond par value. When we're looking at notes payable, for example, we call that the principal of the note. Then to that, we'll have to apply the bond interest rate and the periods. So again, during the life of the bond, the company will have to make interest payments semi-annually, and then at the end of the life of the bond over here, they'll have to repay the bondholders the bond par value, or what is also known as the face value of the bond. So when we look at bond financing, this is a form of debt financing. Remember, when the company issues stock, we call that equity financing. When the company issues bond, that would be debt financing. So bonds really do not create additional ownership in the company. Bonds are kind of like the company going to a creditor and taking out a loan. So bonds do not affect owner's control. The other nice thing about bonds is the interest the company pays to the bondholders is tax deductible, so it reduces income before taxes, and the company doesn't have to pay as much in income tax. Bonds can also increase return on equity. However, they do require the company to be making periodic interest payments to the bondholders. As we discussed on the previous slide, the company has to make those payments semi-annually, and that is a significant cash outflow to the company. So let's look at a bond certificate. So this is slide 6. The bond certificate would specify several different things. Let me see if I can make this bigger. It's a little blurry, so I don't know that you can really see well, but you have this bond certificate in your books. So the bond certificate, this is what the company sells to the bondholders. The bond certificate specifies several pieces of information. It specifies the face value or the par value of the bond. That is the amount that the bondholder allows the company to borrow. So you'll see a bond with a face value of $1,000 was issued. That would be an example of the face value or par value of the bond at the time of issuance. This is what the investor would give the company. Another important piece of information that is on the bond certificate is the stated interest rate. So this certificate here, somewhere on it would specify the interest rate is 10% annually. In addition to that, the bond certificate will specify the maturity date, or when the company has to pay the bondholders back. So bonds are securities, and they are bought or sold on the financial markets. So I used to, back when the internet wasn't, you know, as huge of an information pot as it is now, I used to have to go. I was accounting for bonds issued by TCC actually. So I used to go every Monday to the public library, pull Wall Street Journal to see how the bonds are trading. So bonds, they are trading just like any other securities on the financial market. So bonds that are perceived that are a good investment, they have a market value, they have a bond interest rate higher than the market interest rate. So in this case here, you guys are looking at an IBM bond. The rate is 4%. The IBM stock is actually getting sold at 103.08. That means that this is more of a valuable bond than anything on the market. And you can see down here, the very last sentence, it says the stock is being sold at 103.08. That means that this is a better investment than most things on the market at that point in time. So again, this is an accounting class, so we will be looking at the accounting issues when it comes to bonds, rather than whether it's a better idea to sell stock or what does it cost the company to sell those bonds. We'll be really only looking at how to account when bonds are issued and how to account when interest is paid and bonds are retired. So the very first accounting issue when it comes to bonds is, what do we do at the time of issuance? When we issue bonds and the bonds are issued at par. In other words, the company wants $100,000, the bondholders pay the company $100,000. When a bond is issued at par, the par value and the cash collection will be exactly the same number. So in this case, we have a company that issues bonds at $100,000. The interest rate on the bond certificate is 8%. And then we can see here that the company will be paying interest semi-annually on June 30th and December 31st. This is a 2-year bond. So immediately I need to start thinking this company will pay interest 4 times during the life of the bond. So at on the date the bond is issued, we will debit cash for the cash received, and bonds payable will be credited to show that the company owes the bondholders $100,000. The second accounting issue is when the company has to pay interest. The first thing we need to do is calculate the semi-annual interest payment. You already know how to do that. We did it in the chapter on adjusting journal entries. We did it with notes receivable. So you take the par value of the bond times the interest rate. This here, just these two numbers will give you the interest for the whole year. But remember, the company would pay interest on bonds payable semi-annually. So every 6 months, we have to debit bond interest expense and credit cash to account for the interest payment and the interest expense every 6 months until the bond matures. At the end of the life of the bond, at maturity, the company will pay the $100,000 they borrowed from their bondholders. So these are the 3 accounting issues. I'm going to click through them one more time. When we issue the bond, when we pay interest to the bondholders, and when we pay the face value of the bond to the bondholders. Now, it may seem like pretty straightforward, and it is, but there is something that complicates accounting for bonds. So if I look at slide 12, there is a comparison that we need to make whenever bonds are issued, and that comparison is between the bond that the company issues and the market. So if at the time of issuance, the bond interest rate is higher than the market rate, we call that bond a premium bond. So again, the stated or the contract rate, if that is higher than the market rate, the bond is perceived from investors as a good investment and is sold at a premium. What that means is that the company will get more cash up front. Investors like to reward companies that they perceive as good investments. If the stated interest rate on the bond certificate or the contract rate equals exactly the market rate, we call that bond a par bond, or the bond sells at par. If the contract rate is less than the market rate, then the bond sells at a discount. So each one of these situations will be accounted for differently. This one in the middle is what I showed you a couple of minutes ago with these slides. See, this is a bond that's issued at par. There are no complications. So for the next few minutes, we'll talk about how to deal with discount bonds and then how to deal with premium bonds. Again, you will know what bond you are dealing with by comparing the contract or the bond interest rate to the market interest rate. So let's go ahead and look at a discount bond. FILA issues bonds with the following provisions. We know the par value. We know the issue price. Look at the issue price. This right here means that the company will not get $100,000. They will only get $96,400 because investors perceive this as a not as a great investment. The bond stated interest rate is 8%. The market interest rate is 10. I'll make the comparison immediately and see that the stated interest rate is 2% lower than the market interest rate. I will know that I'm working with a bond that will sell at a discount, or as I called it earlier, a discounted bond. Why is this important? It is important because the issue price of the bond, or in other words, the cash the company will collect, will be less than what they have to pay back their investors. So let me show you how this is accounted for. Par value is $100,000. The bond is issued at 96.4%. So because this is a discounted bond, the company will issue $100,000 worth of bonds, but they will only get $96,400. The difference is what we call discount on bonds payable. This is a contra liability account. This contra liability account and bonds payable exist hand in hand. You will never see a discount on bonds payable just hanging out there by itself. So the discount on bond payable, it has to be amortized. It has to be taken off the books by the time the bond matures. On the balance sheet, the company will report the bonds payable at $100,000, will subtract the discount on bonds payable. So whatever is left from the maturity value of the bond we'll call carrying value. This is what the company has to show on their books. The only acceptable way to make discount bonds disappear is by amortizing them. We amortize bonds using the straight line method. And you probably remember back in chapter 8 when we studied long-term assets, you learned how to calculate the straight line amortization when it came to patents and the straight line depreciation when it came to long-term assets. So what we're going to do here is we will look at this bond discount, the $3,600, and every time the company pays interest, will decrease the value of the discount until it's zero. So the straight line amortization is pretty simple. We have a discount of $3,600. If I divide the $3,600 by the number of times the company pays interest, or 4, see we have 1, 2, 3, 4 interest payments, I can amortize $900 of the value of that bond every 6 months. So when it comes to premium bonds, sorry about that, premium bonds are different because this time the market would consider a bond with a higher than the market rate a good investment. So investors will reward the issuers of the bond by giving them more than what the par value is. So in this case, Adidas issues bonds. The par value is $100,000. The issue price is 103.6. That means that the company will get more cash than the par value, and similar conditions apply. They will be paying interest semi-annually, and the bond is a 2-year bond. Accounting issues contain the following journal entries. When the bond is issued, because this is a premium bond, you notice right here the cash collection that the company makes is 103,600. The bonds are only 100,000, so the difference between the two is called premium on bonds payable. Premium on bonds payable, just like discount on bonds payable, does not exist in isolation. It goes hand in hand with bonds payable. But unlike discount on bonds payable, which is a contra liability account, premium on bonds payable is called an adjunct liability account. It behaves just like bonds payable. It increases on the credit side and decreases on the debit side. On the balance sheet, we report the premium and the bonds payable together. The carrying value is not 100,000, which is the maturity value, it's 103,000. Just like discount, we need to amortize the premium over a certain period of time. So we know that every 6 months, the company will have to pay interest to the bondholders. While they calculate and pay the interest, they will also have to figure out the bond amortization. Just like before, we need to amortize the premium on bonds by using the straight line amortization. In this case, we have a premium of 3,600 and 1, 2, 3, 4 periods to amortize it over. So every period, I'll be subtracting $900 from the premium account until it gets down to 0. The last accounting issue would be retirement of the bond. The bond could be retired before maturity or at maturity. So let's look at a journal entry here. This is the bond, which was a par value bond. When it gets retired, the company will close the bonds payable account and they'll credit cash. Because at that point in time, if there was any discount or premium, they'd be fully amortized. So these accounts will be zeroed out. If, however, the bond retirement happens before maturity, the company will have to report a gain or a loss, depending on whether the carrying value of the bond is higher or lower of the retirement price. So like I said, I would love for you guys to look at the terminology and be more comfortable with it before Wednesday, so we can have a more meaningful conversation when we start working problems. All right, so let's talk about a couple of other things. Another long-term, this is slide 29, another long-term liability account is long-term notes payable. One of the things that you know is how to work with short-term notes payable. We did that in the chapter on adjusting journal entries and short-term liabilities. So long-term notes payable are very similar. The company borrows from a lender. It creates a note payable. Note payable is a interest-bearing instrument. So not only we need to record the note payable on the note date, we also need to record what happens at maturity. So when we look at long-term notes payable, the company can make a single interest payment at maturity, or just like bonds, they can make interest payments throughout the life of the bond. And you guys are really, you're familiar with installment notes and mortgages. So installment notes, such as your car loans or mortgage loans, they have equal payments. And I'll show you how this works here in just a second. So whenever you guys borrow from a lender to purchase a vehicle, they give you a schedule with the exact payments. So every time you make a payment, part of the payment will go to cover the principal of the loan, and part of the payment, the payment will cover, or part of the payment will cover the principal. And it's really interesting because when you look at the first year of the loan, you can see how interest is quite high. As the loan nears maturity, the interest piece of those equal payments decrease as well. So you will have to understand long-term notes payable as well as mortgage notes. In terms of, this is a long-term obligation, mortgages have an equal payment, and you should understand that interest is predominantly part of the payment up front, and then that switches over. Most of the payment becomes or is applied to the principal in the later years of the note, mortgage, and bonds payable. All right. So just like every chapter, this chapter has its own ratio. This is the debt to equity ratio. And basically, debt to equity is total liabilities divided by total equity. This ratio helps investors, bondholders determine the risk of investing in the company by determining how much liabilities they have compared to stockholders' equity. Please go over the chapter whenever you get a chance, because if you don't understand the terminology, you guys are not going to be able to work problems with me next time. So on Wednesday, in addition to working a few problems, I will also have a few things for your exam 3. Does anyone have any questions? If you don't, read away. Hey, Dave. Let me look at that real quick, because it is not my intention to not have